Hey guys, bit of a different video today. I'm going to react to a video from Stephan called The Housing Market is Sinking. I'm going to give you my perspective as a British property investor on what he's saying about the current state of the American market. So let's jump right into it. First things first, guys, we must remember to hit the like button, which you've just done, and you can do that down below on this video as well. I'm already subscribed, so if you guys can subscribe to this channel and make sure you turn the notification bell on, that would be great. And let's jump right into it.
What's up, guys? It's Graham here. So let's talk about something that I'm sure most of us have considered in some way or another, and that would be the next housing crash. After all, in the last month...
Which is really interesting because I was listening to a podcast the other day and they're saying it's called the Property Podcast, and they're basically talking about how they think we're at the start of a boom cycle on the 18-year property cycle, which is really interesting because it is definitely gonna pop. It's just when. That's the big question.
Housing prices have continued to hit record high after record high, inventories at its lowest level in history, and across all metrics, a recent survey found that the overwhelming majority of Americans now feel like it's a good time to sell a home, but a bad time to buy one, with even the search term housing crash having just increased 100% to the highest level it's ever been.
Which is really interesting because I've spoken to quite a few people who think about doing this, like thinking about selling their own home. Which is great because you can cash in on it, but then you get it at the other end when you then go to buy. So it's a bit of a double bubble. You know, you're robbing Peter to pay Paul in that way because you'll make a load of money, but then you'll also spend a load more money when it comes to buying a property on the other end. So it's a bit of a catch-22. I mean, you can understand it from a landlord's point of view if you've got maybe an asset that's poorly performing, maybe one of your worst buy-to-lets or something, and you want to offload it. Now's the time to do that, and then eventually down the line you could use that money to reinvest into the market.
That's not exactly surprising either, considering that interest rates are said to increase faster than we initially expected. The eviction ban was just postponed.
Yeah, I think inflation's higher in the States as well. I think it's around about 5%, where it was 2.5 in the UK.
Another 60 days, and now with foreclosures being allowed to move forward, there's certainly the concern that a wave of homes is going to hit the market as Congress keeps kicking the can further and further down the road until eventually it's too late. But thankfully, there are some things that you can do now ahead of time to make sure you're in the best position possible to come out ahead profitable. So that way, no matter what happens, you're totally prepared to print tendies. But really quick, before we dive into the current state of the real estate market, I want to say a huge thank you to the sponsor of today's video, the like button. Unfortunately, 90% of viewers leave that like button unsmashed, and that is unacceptable. For the low cost of just absolutely nothing, you could give the like button the click it deserves. And as a thank you for doing that and helping out the almighty YouTube algorithm, I will do my best to respond to as many of your comments as I possibly can. So thank you guys so much, and now with that said, let's begin. Alright, so first...
That's something he's really good at. He's really good at that side of the marketing when it comes to his YouTube channel.
In order to figure out how to best prepare for something like this, we should cover the severity of the real estate crashes that have happened in the past. Because even though it's easy to think that the market is going to crash and I'm never going to be able to financially recover from this, the truth is, with some preparation ahead of time, losing money in the long term is actually fairly rare. And yes, I did just use an old meme. I hope you enjoy it. Anyway, the first major real estate crash we gotta talk about is the Great Depression of 1929. Now, here's the thing. Most people know this as the infamous stock market collapse where prices dropped 83% over 2.8 years. But because of the mechanics behind the crash, real estate was also significantly impacted as well.
Yeah, that's something I didn't know about the real estate crash in 1929.
Because prior to 1929, the economy was booming. Money was pouring out of every crevice. Banks lent money to anybody who asked. And people, for a lack of a better word, just speculated on everything because values kept going up. However, once the market showed even the slightest glimpse of a peak, people began selling out of everything and withdrawing their money from the banks for fear that the banks would be going out of business. But banks didn't have enough money on hand to give back to their customers all at the exact same time, so they began shutting down. That meant that afterwards, the banks left standing didn't have extra money to lend out. Assets were seen as too risky, and because of that, real estate suffered and saw a 67% decline in price for nearly 2 decades. But thankfully, though, afterwards, real estate didn't see a big decline until much later in the 1990s. Now, prior to then, the real estate market saw a huge increase due to new lending options, a growing population, low interest rates, and easing regulation. But the savings and
which is interesting because I know the interest rate in the 1990s in the UK was like, you know, it was really high. It was like talking like 15-17% at the start of the 90s. So this is where there's a difference between the UK and America in that.
Home crisis caused interest rates to suddenly go up, home construction dropped, and housing prices remained fairly flat until 1997, which then leads us to the next real estate crash in 2009. This was
The big one.
caused by too many people.
The big one.
People speculating on the value of real estate, fueled by short-term, cheap, temporary, adjustable-rate mortgages that allowed anyone to buy it.
Yeah, which is the this impact the whole world. You could get 125% mortgages, so you could buy a house and literally get paid for buying it on the same day. You could refinance. It was all sorts of mad stuff going on. Absolutely crazy.
Home as long as they were able to make the introductory rate payments. However, a lot of those loans had what's called a balloon payment, which caused the price to go up substantially after a few years, and that was a disaster. People began defaulting on their loans, inventory flooded the market, banks went out of business, and the housing market fell 33% throughout the US, with some harder hit markets declining more than 70%. However,
which will be similar to this, so similar sort of thing happened in this country, and that is in fact where a lot of the biggest investors today, that's when they struck when the iron was sort of hot. That's the opportunity they took. So again, when it eventually does dip again, it's going to be a massive opportunity for people to build their wealth in a really big way.
However, the interesting part with all of this is that throughout the last 100 years, with the exception of both 1929 and 2009, for the most part, housing prices have been fairly resilient decade over decade.
Yeah, same in the UK, roughly doubled every single 10 years. Obviously not spot on, but roughly doubled every single 10 years.
After World War II in the 1940s, housing prices and construction boomed due to a surge of demand. Then during the 1970s stagflation era, real estate kept going up from an increase of inflation. Then during the 1980s recession...
Because when there's high inflation, people want assets, something that's inflation proof. So that's why you want to buy, get into property, because it's a hedge against inflation.
Real estate went up another 4.5% as inflation stayed high. The 1990s saw some markets drop, but the hardest hit areas didn't even decline 10%. The dot-com bubble had very little impact on real estate prices as interest rates went down. But now with housing prices at the highest level they've ever been, with most Americans thinking it's a bad time to buy a house, we have some different challenges.
Which is the same in the UK. So recently, I think it was a couple of days ago, they announced it's the highest average house price is at the moment, which just shows you the state of the market.
Challenges today that will directly impact the real estate market. And when it comes to some of these issues that might happen, there are 5 points to consider. The first, rising interest rates. It's no surprise this is one of the main reasons why real estate saw such a huge price increase to begin with. When the Federal Reserve lowered their benchmark interest rates all the way down to 0% in March of 2020, would-be homeowners took that as an opportunity to lock in a really cheap loan that would allow them to purchase even more house and...
Which is a really important point, because at this sort of time, this is when rich people can use these low interest rates to build their net worth again, because it's super low rates. I think I've seen a 5-year fixed Barclays one at 1 point something. With inflation being at 2.5%, it's lower than inflation, so it's just absolutely, it's so cheap to lend money at the moment.
Therefore drive up the price. That's because home prices and interest rates are directly correlated, and since the 1970s, the lower interest rates go, the faster home values increase, leaving us in a unique position where eventually interest rates might have to go back up. Now, originally this was planned to happen in late 2023, but now that inflation is rising fast...
And that's the other thing, so since like 2008, 2009, like I spoke about them, interest rates in the UK have been like really low. Really, really low, like 2%, 1%, 0.5%. It's been mega low. So we've never been used to high interest rates, but like I said, in the 90s, if you speak to people who were buying property in the 90s, they say it was like 16-17% interest on the mortgage. So it's just absolutely ridiculous. But you were getting that in the bank as well. So.
Than expected, some anticipate that a rate increase could happen as soon as 2022, meaning the cost of a mortgage could get more expensive, and that would put downward pressure on housing prices.
Yep.
The second, more inventory for sale. Now, here's the thing. As the pandemic began to take shape in March of last year, fewer properties were listed on the market for sale, realtors had a difficult time showing properties, and sellers preferred to take their home off the market and stay put rather than sell their home and put themselves at risk. But when you combine that with low interest rates and eager buyers willing to scoop up anything they can just to lock in a loan, that limited inventory pushed prices way higher than expected. On top of that, construction was also delayed due to a shortage of building materials, supply chain issues, and a scarcity of labor, which meant that even...
Yeah, which was, still a knock-on effect going on at the moment with some of the big house builders in the UK.
Builders wanted wanted to construct more homes, they couldn't, which then led to prices moving even higher. But now that might soon start to change, with inventory increasing for the first time in a year. And as the economy slowly begins to open back up, more and more sellers might feel comfortable finally cashing out of their homes and adding more inventory on the market for buyers to choose from. The third, buyer optimism is also declining. This was discovered by a survey conducted by Fannie Mae, which found that overall 70% of Americans felt like it was a good time to sell, and 64% said that it was a bad time to buy. That's said to indicate that buyers are reaching a tipping point from what they're willing to pay. And
yeah, which is always going to happen. If there's only a certain amount of time, people are going to get fed up with it. There's only a certain amount of people who'll do that for a certain amount of time. So yeah, that's a really interesting report.
This can only get so expensive before eventually people are outpriced and are forced to wait on the sidelines for things to come back down.
Yeah, and that's something. So I'm looking obviously to buy my first buy-to-let property, and this is something we're experiencing a lot at the moment. But if you're a first-time buyer as well, it's really tough, and it's difficult to not get involved in the overpaying for an asset game.
Building materials are also coming down in price as well. Now, this has been a really hot topic lately because in the last year, lumber prices have increased up to 400%, adding on roughly
Yeah, lumber's the investment to do.
$36,000 to the cost of buying a new home. On top of that, supply chain issues and limited capacity also raise the cost of home insulation, plumbing fixtures, paint, stone, and everything else it takes to build a house.
And not just that, it's also getting trades in as well, getting people who have capacity to do the work. And particularly in the UK, a lot of people are getting pinged at the moment, so that's a really big issue.
So what winds up happening is that increased cost gets passed on to you as the customer, while home construction costs went up 18% just from that alone. But the good news is that lumber prices are finally falling, down about 68% since the peak. Housing materials are also falling.
Which is also another interesting one, because that eventually is, like he was talking before, about more inventory coming into the market. That will happen with the supply chain as well. So like I remember, I think it was somewhere in Russia, I was reading an article saying like they're basically cutting down wood now to try and meet with this new demand for lumber. But eventually that's going to reach a tipping point where there's going to be too much supply and not enough demand, and then prices will start to go back down.
Falling in price alongside with it as Americans are spending more time outside and finally going on vacations instead of taking up home renovation projects and building. All of this is to say that the cost of building a home might soon start to come back down. And finally, fifth, we have the eventual end of both the eviction and foreclosure moratorium. These were the protections put in place during the beginning of the pandemic to prevent both tenants and homeowners from being displaced from their homes. For tenants, this included a ban on evictions that was just recently extended through October, and for homeowners, they had the option to claim mortgage forbearance and temporarily pause their payments for up to a year.
Which is something, a lot of governments around the world have been doing. They just keep kicking the can down the road with this. So it's like similar to furlough in the UK. That got extended and extended and extended again. So there is going to be a tipping point where this happens, and people are going to get evicted at some point.
But now, as both of those protections are beginning to come to an end, the concern is now shifted to what happens when they expire, and is that going to lead to more inventory on the market from homeowners who need to sell? Well, that's not exactly clear, because even though we have a list of reasons why real estate could go down, we have just as many reasons it could go back up. For example, first, interest rates are still at historic lows, and they could stay there for quite some time. Even though some expect rates to rise as soon as 2022.
Which again, like we said, when interest rates are low, the cost of lending is low, so people who have access to that lending like to get into property and hold assets because it's so cheap to lend.
Jerome Powell still maintains that rates will stay near 0% through 2023, meaning we could continue to see more demand for mortgages, further boosting up prices more than they are now. Second, even though more homes are coming on the market, there's still a dramatic shortage of inventory in the U.S. In the big picture, inventory is down 43% since June of last year. And nationally, the typical home is only on the market for 37 days, compared with 72 days during the same time in 2020.
Which just shows you how mental it is, and it's not too dissimilar here.
And even though more inventory is coming on the market, listing prices are still rising, which indicates there's still no shortage of buyers out there willing to pay whatever it takes to get a house. The third, even though building materials are also coming down in price, they still have a long ways to go. That's because supply chain shortages still have an impact on how much material can be produced. And because of that, economists say that demand for lumber is expected to hold up well for quite some time. Although supply should rebound, the price of lumber should sharply decline by the end of 2022 as lumber imports increase. Fourth, we could continue to see more more home buying demand from both millennials and Gen Z over the coming years, further boosting up prices. Like, it was reported that this year, millennials have dominated the home buying market. But soon,
which again is like literally probably one of the worst times. One of the worst times in the last 20 years, probably, to be buying your first home is probably now.
Approaching as Gen Z, and with 72% of them saying that they eventually want to buy a home, that could mean eventually even more buyers lining up to place offers. And fifth, the risks of a new shutdown could potentially halt the recovery and limit the amount of new inventory coming on the market. That's because the longer our economy is restricted, the lower interest rates will stay, the less material can be produced, the less people want to move, and the higher the prices will generally be, as we've seen throughout the last year. And all of this, of course...
And that's something, so it seems in America they're quite a bit behind us in terms of the Delta variant. Like, we sort of had that a couple of months ago in the UK, and they're sort of getting it now in America. So yeah, there's been quite a lot of talk in the States whether they're going to start locking stuff down again or not.
Of course, is just speculation, but the reality is we have no idea what's going to happen. And that means accurately predicting what's going to happen.
And that's the other thing with predictions, is like, it's like I could sit here and say to you guys, it's going to crash. You know, that's not like a magic insight, is it? It's about saying when. When's the big thing, because you could leave open-ended things all the time. Say, oh, well, it's going to crash. Well, yeah, of course it's going to crash, but when's it going to crash? That's the big issue.
With the real estate market is next to impossible. But at least the good news is, regardless of what happens, whether the market goes up or it goes down, there are some things that you could do immediately to make sure you come out ahead profitable, and this is what you need to know. The first thing that I would recommend everybody do is get a 30-year mortgage. That's because the 30-year interest rates are still the lowest they've ever been in history. And when you consider that your long-term investment returns are going to be way higher than your mortgage interest rate, it starts making a lot of sense not to pay off your mortgage early and invest the difference instead.
Yeah, which is a big thing when interest rates are low. Lock it in for as long as possible, like you said there, and then anything else you get over that, because particularly with the low interest rates and inflation going up, you know, the net is you'll be making more money, because you'll effectively be getting paid to pay down your house, because the interest rate is so cheap compared to like how much inflation's going up. And then, like he says there, invest the difference, so you could save it for another part, or you can invest it into stock market or crypto or whatever.
To mention, inflation makes your mortgage easier to pay off with future dollars. So the longer you keep it and the higher inflation is, the cheaper that loan becomes.
So the way that works is because obviously inflation goes up, so the value of your dollars or pounds in your pocket is worth less. So it has the same effect on debt. So, you know, let's just say £100,000 now is not going to have the same value as £100,000 in, you know, 20 years.
The 30-year mortgage also gives you the major advantage of flexibility. Like, there's nothing stopping you from paying off a 30-year mortgage in 15 years if that's your priority. Just double up on your payments and voila, it's the same thing. But if something comes up, you lose your job, or you need to pay a little bit less, a 30-year mortgage gives you the flexibility to make the minimum payment and save the difference.
Yeah, that's a good point.
Instead of locking yourself into a higher payment up front, like with a 15-year mortgage. Second, always get a fixed interest rate. Right now, with rates so low, it makes sense to get a fixed payment every single month until your loan is paid off.
Yeah, I agree with this. So I done this on my own home a couple of years ago. For me, I just prefer knowing what you're going to pay every month. You can get them variable, but based on the interest rates, and obviously the interest rates have been super low, but you know, just having that consistency, especially when it's as cheap as it is now, yeah, that's a really good idea.
Locking in your rate, you'll know exactly what it's going to cost you every single month for the next 30 years, and from that, you can plan accordingly.
Yeah, which is really good for cash flow forecasts when you're doing your rental.
Also prevents your payments from suddenly being increased 5 to 7 years from now if payments are higher in the future than they are today.
Or if you're on a shorter mortgage and you have to get a different mortgage and interest rates are different, you know, it can change the whole outlook of the investment.
If that were to happen while the real estate market is down, not only is that going to cost you more money, but the market is falling alongside with it. So go ahead and lock in your interest rate, and then no matter what happens, your payment is guaranteed to stay the same. The third, while we're on the topic of loans, you should refinance your mortgage to save more money. Now, most likely, if you own a home already, you've probably either done this or at least considered it. But if you have the opportunity to refinance your house and save a little bit of money, I would go for it. This allows you to get a brand new loan that replaces your existing loan. And in many situations, the new loan is going to be at a lower interest rate than what you're currently paying, thereby saving you more money every single month. The fourth one,
like we said, if it's lower than inflation, in reality, you're actually getting paid to pay down your house.
One of the best ways to make it through a real estate crash is to only buy a home that you plan on keeping for at least 7 to 10 years. The truth is, real estate values only matter in the short term if you intend on selling. So everything I've mentioned...
Which is something, so like I said, I'm looking for my first buy-to-let at the moment, and obviously the market is hot, but this is where, you know, it's also, it's almost inconsequential, the price now, if you hold it for, well, for me, it's going to be at least 25 years, so...
so far is designed to keep your payments as low and predictable as possible to prevent you from needing to sell. Then ideally, by not selling, you'll have the time to ride through any fluctuations in price until eventually you're back to profitability.
There's something that's interesting with property particularly is like, if you, like, say for example, I'm investing into Tesla, I can go on every day and see how much I'm up or down on my Tesla. It's not... It doesn't really work like that with property. You know, you can't log onto something and say like, oh well, this is exactly how much my house is worth in this moment, and I'm down this, I'm up this. So in a way, it's good because it takes the emotion out of it, which makes it easier for the long term, I think. And given that you've got that historic data as well for the long term, saying it always goes up and roughly doubles in the UK every 10 years.
And fifth, if you're buying a property as an investment, you should focus on cash flow first, value second. I know it sounds kind of counterintuitive, but when you invest in real estate, the value of the house doesn't make much of a difference. You just care instead about how much that property is making you every month. And the good news for something like this is that usually if real estate values are falling and fewer people are buying, they're renting instead, which means you have more options for tenancy. Not to mention rental prices tend to be completely immune and stable from any real estate price drops. So even if real estate values go down, the rental prices should stay the same or even increase.
Which we've also got a really strong rental market at the moment as well.
And sixth, the best piece of advice for anyone watching is to only buy a home that you could comfortably afford. Never max out the loan that you're able to qualify for. Never extend yourself too far because the house is awesome. Never spend more than 35% of your income on housing payments. And instead, get something that is not going to cost you more than what you could reasonably pay if your income goes down or you lose your job.
Yeah, this is such a massive point, and I think what happens with a lot of the time with people is they will go and get a mortgage in principle, and they'll get told you can lend X amount, and they'll think, oh yeah, well we'll just go for the top end of that. It's not the point, because you know, it's like you said there, 30 to 35% of your monthly income is what you should be aiming for, because you still want to be able to live your life, and then you still want a buffer in there, because if anything happens with your job and your income massively drops, you then can no longer afford this lifestyle, and it's really difficult. But that's where I think ego comes in for a lot of people, and keeping up with the Joneses and stuff like that. So that is such a massive point.
Reality is, the lower your payment is in relation to how much money you make, the safer you're going to be able to keep it through a downturn without running out of money or without having a difficult time staying afloat. Real estate should ideally only be something you buy if you plan on keeping it at least 7 to 10 years with a fixed interest rate locked in for 30 years on a payment that you could reasonably afford. And that way, even if the entire market goes to poop, you'll be able to get through it just fine without any change to your day-to-day life.
Which is worst case scenario with everything like happened in 2008. You need to think worst case.
And lastly, let me just say this. There's no shortage of people out there wondering if it's a good time to buy a house or if they should wait for prices to come down. And my philosophy is, who knows? There's really just as many reasonable arguments why the market should go down.
And this is back to predictions. You know, everyone's got a prediction. Oh, yeah, it's going to go up, it's going to go down. Well, when? You know, that's the thing. It's easy to say those things.
As there are that the market should get even more expensive. So as long as you could stick with those few points I just mentioned, take your time, buy a house that you could afford, and plan to hold on to it at least 7 to 10 years, the chance of you losing money long term is fairly slim. And the difference between you buying now and later is going to be fairly nominal. I think it's way more important instead to focus on what you can control, like maintaining your own finances, buying less than what you can afford, keeping a budget, saving money, and keep an emergency fund.
And a really good credit score as well. So yeah, try and do all that sort of stuff. So I try and save around 60% of my income every month, and invest it and save it for buy-to-lets.
I'm a firm believer that those habits will take you way further than perfectly trying to time the real estate market, along with, of course, smashing the like button.
Which you need to do on this video as well.
So with that said, you guys, thank you so much for watching. I really appreciate it.
Yeah, subscribe. Please subscribe to my channel below. That was another absolute belter from Graham Stephan. Really is someone I take massive inspiration from, and talks a shed load of sense when it comes to this stuff, in terms of being risk averse and protecting yourself and making sure you live below your means in case anything goes wrong. So yeah, really good video. Don't forget to like this video, guys, subscribe to the channel, and yeah, cheers, see you in the next one. Thank you.